Hello everyone. So I got a fun little video today. I want to do an economic and trading forecast. This is basically just a foundation for more videos to come on the Federal Reserve. I want to try and figure out this new Federal Reserve chair, what he's all about, and how the Federal Reserve could be changing itself going forward. But let me start. So first, this is the NASDAQ, and I realized I was doing just kind of like looking at the charts, and I realized how the daily chart looked pretty bad. It looks like we're going to get a correction. Double top, heavy bearishness, making lower lows after leaving a double top with a lower low, and at the same time, the Dow, which is more industry, safer, commodities, bonds, is pretty much flat and making higher highs compared to that line, with the NASDAQ. And this is showing that higher risk, like tech stocks, are, not as attractive right now and are being sold off compared to, money is flowing into safer assets, safer things. I'm going to show you a handful of things that kind of confirm this, but also I'm not saying that this is a very bad thing. This could just be a simple pullback in only equities and different. There's more things like how silver and the dollar is moving that you could use to build a case that a big crisis is coming and AI bubbles popping. But as of now, I'm not saying that. I just want to focus on equities and the bond market and the Federal Reserve. Those are my three concerns. No, in no way is this saying that we're gonna have a huge pullback that's gonna make the Nasdaq drop 50% and stay lower for 5 years. Okay, but maybe this will turn into that. So far, I'm not seeing that though. Anyways, moving to the bond market. Okay, so I talked about how money is flowing into safer assets, and we could be seeing a pullback in tech. But here's the 10-year yields versus the 2-year yields, 10-year on the left and the 2-year on the right. Now, the U.S. government bonds pays a yield. It's basically just holding U.S. dollars in cash, but you're getting paid a yield. So it's like a little note that the government writes you and says that they will pay you back this much money at the end of a certain term. And every year that you're holding this note, they'll pay you a certain percentage. So for the 10-year, it's 4.493%. For the 2-year, it's 4.2%, relatively the same. But when you think about how big the U.S. economy is, the trillions of dollars in this market, that 0.5% is pretty, well, not even, but almost 0.3% is pretty huge. Okay, so think of this 10-year versus 2-year. Think of it as if you're asking over the next 10 years, how will rates and growth be like compared to today? So that's pretty much what you could be asking yourself when you're trying to compare the two. 2 years very short term, a shorter window, and 10 years a longer horizon. Here I have in blue highlighted the end of the U.S.-Iran conflict when tensions are at the highest. Not the end of it, but when tensions are at the highest and then things start to settle in, they started to talk about peace, and people started to believe that, okay, well, the market at least started to believe. I remember the narratives were not this in May, and I was pointing this out in May and saying that the market is starting to put money back into risk assets, and it's not worrying about what people think anymore. And then eventually, this second drop is when people started being like, okay, now we're good. Now it's done. But here you see June 15th. Following, I don't think I meant to highlight June 15th, but this is, I guess this is where the U.S.-Iran war, actually, I meant to highlight this candle. Yeah, okay. Oh, sorry. Yeah, no, June 15th is the candle I meant to highlight. This is the Federal Reserve, the day where they had their press conference. Actually, I meant to highlight Wednesday. On the Wednesday where they had their press conference. So you see the 2-year, how much more it went up versus the 10-year on that candle, pretty much flat, while the 2-year is making new highs. This is pretty much showing you that short-term investors are demanding a higher return to hold bonds in the short term versus the long term. So pretty much they think something bad is coming over the next 2 years or less. Could be the next 6 months, could be the next 3 months. My point here is that if there was something very, very bad, like an AI bubble collapsing, we would see the 10-year do something like the 2-year. So that hasn't happened yet. You could see the move, which is kind of like the VIX for equities, but it's the volatility index for the bond market. And you can see it's not really, it's flat. The blue line is at the peak of the crisis, May 19th, and then we kind of have still stayed down from where we were. No, sorry, the peak of the crisis was the beginning of April up here. And then this is when the public kind of like started to accept that there's going to be peace. Okay, so we haven't really went anywhere. Now, what this means is that even if 2 years going crazy and the Nasdaq might drop by a lot in the coming weeks, the bond market is usually the first one to signal that something is wrong. When the war started happening in March, right, the bond market was already, the volatility was already happening. And it's the same thing with the Russia war, with all the other wars in the past. The bond market is all like, this was, I think, with Japan, and how they started hiking rates. The bond market always reacts the first, and since it's not reacting and the Nasdaq already started reacting, if we're going to have a pullback, it should probably only stay in the equities unless something bigger happens. Maybe the Nasdaq causes more dominoes to fall, because an AI bubble could pop. And I don't know if that's the case. I don't know. Maybe not. But the bond market is, so far, from this perspective, is healthy for the bigger economy. This is the FII 10. It's a very important chart to focus on. But what this is the difference between the 10-year nominal yields and inflation. So this is pretty much the real yields that investors are getting. Well, according to what the inflation is, according to the Federal Reserve. So 2.28% is pretty much, if you were to hold a government bond, your cash grows at 2.28%, right? If you factor in inflation. So it's the bond yields adjusted for inflation over 10 years. So the 10-year yield. Now, how this influences with rate cycles and trading too, the important note for trading, but the market and different models are heavily correlated to these cycles. Maybe not all models, but some models and some like markets, just like when you wake up in the morning, you see, oh, the market's moving nicely, blah, 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 has a lot to do with this. But anyways, so here since 2011, the US has had record low inflation and unemployment. Now, unemployment, usually if everyone's employed and everyone has a job, well, you should have a lot of inflation. Not always though, but in this case, for a very long time, the United States struggled creating higher inflation, even despite them having low unemployment. So this meant that the Federal Reserve had no choice to make borrowing cheaper until COVID. Okay, COVID happened. Lots of money was printed. I mean, the government was giving out money for people that didn't have jobs. The Federal Reserve created special vehicles that allowed them to buy corporate debt, and other countries and investors to buy corporate debt at very cheap rates, near 0%. All these companies were loaded on cash. Some people were hired and sat in offices doing nothing and were paid huge salaries. Money was given out for free practically. Money was abundant. I remember working for a crypto OTC desk. I still work for them, but we remember 2021, 2022, were some of the best years because everyone had money to buy Bitcoin. They would just go to Bitcoin ATMs and counters and buy so much with all the cash they had. So now it's a lot less of that, and ever since 2024, 2025, we started to see kind of like the post kind of like, okay, it's correcting, the post correction. But anyways, lots of inflation created the need for rate hikes. So the first rate hike happened in March 16th, 2022. And then this caused the real yields to go up because as rates went higher and inflation went higher, investors started getting more because, well, I mean, I don't have a chart of the 10-year that goes all the way back to where it was in 2022, but it was near 0%. Like it was like 0.25% or something. So like, you see how they were literally, investors were literally negative. Like if you factor in inflation, they were losing money. If you were borrowing money, you got paid for borrowing money. If you lent out money, you would lose. That's how that's pretty much adjusted to inflation. That's pretty much what it was. And now it's not like that. Now the economy is restrictive. If you're borrowing money, if you're holding cash, you're losing, adjusted to inflation. So, and by the way, actually, I don't even. Let me stay on. I don't want to ramble on. Stay on topic. All right. So, anyways, through the next year or so, until July 2023, Federal Reserve hiked rates. They hiked last time in July 26th of 2023. And then for the next 2 years, this was a very fun time, but they literally just didn't do anything. They sat on their hands and they gaslighted the market into saying things like the economic outlook is always changing. We expect this many cuts, and media and investors were expecting this many cuts to happen every year. Every year was something new. Oh, this summer there will be 2 cuts. Next winter there's gonna be one more cut. Like we haven't had the summer cuts, but there'll definitely for sure be one cut by the end of the year. I remember making a bet with my coworker, actually my boss. He was my boss, and I made a bet, and we were sitting there in the store, and he was like debating about the Federal Reserve, how they're gonna cut rates with me, and like, it was fun. I don't remember what was said, but anyways, it's just it was kind of like a crazy time where people just were kept on continuously being disappointed by no rate cuts. And then finally, huge celebration in September, they cut for the first time. And what happened to real yields? They only went up. This is because inflation continued going down. And now inflation is kind of sticky. It's a bit weird. I'm going to talk about inflation next and how the Federal Reserve sees inflation. I have no idea what's going to happen here with this chart. If it keeps going up, then my guess is that the Federal Reserve raises rates, and inflation is steady or sticky. And if it, or else probably what I think is going to happen is it's going to keep moving in this sideways range for a lot longer until something big happens. Like, I'm not saying something big as in bad either. I mean like something huge, like that changes things. Like I don't know. We build an orbital data center, and now AI controls everything. I don't know, or the monetary system becomes digitalized and we're in stable coins, something like this, something that not necessarily bad, but maybe it's something bad. I don't know. So, anyways, and also more importantly, an actual direction where the economic outlook is certain, and we know what's happening, and the Federal Reserve is going to act on it. I don't think until we have something like this, I don't think that this sideways, we're going to get out of this sideways range. I don't think so. I think we're going to keep seeing more of the same. We're pull back, and then we're going to go up, pull back, go up, until there's an actual direction and something snaps, or like something big changes structurally. But I know one more kind of image. This is the 2-year expected inflation, and then this is the 10-year break even. Just real quick, the expected versus break even. Break even is adjusted every month and quarter, while expected is just a statistical model um, of I don't know exactly how they calculate it, but it's based on the bond market, and every second it trades, it updates. While this only updates at the end of the month or quarter. I think it's either or. I'm pretty sure it's month, but because on my chart it's month, but some places it's quarter. I don't know. So point is that the break evens are much more like what's actually happening, what investors are actually holding over the long term, while 2 years is a statistical model that's created by the Federal Reserve Bank of Cleveland to kind of get an approximation of what inflation will be like over the next 2 years. But you can see that the inflation over the next 10 years has declined a lot more than where it will be over the next 2 years. So this is kind of like more evidence to say that inflation is going to be higher for the next 2 years, like around 2 to 3%, while over the next 10 years it's falling. And this is not saying that in 10 years it'll be at 2.2%. I don't think so. Actually, maybe it is. I don't know. Forget I said that. But one important thing Kevin Warsh kind of said in the meeting was that he's less interested when it came to inflation. He's less interested on the right side of the decimal, and he's more interested on the left side. So the Federal Reserve has had this 2% inflation goal for years, since they started since I guess COVID happened. They had this 2% goal where they're going to get inflation back to 2% and stabilize it there, and have this soft landing, and everyone's going to be happy. Well, I've always said that 2% is an average inflation. So here's where, like, I was gonna do this in the second video, where I actually show speeches, because I don't think that I can. You're just gonna have to take my word for it. But if I actually had the words of the Federal Reserve members, they would be much easier. Whereas inflation, yes, okay. So look at how since like 1998. Well, let me draw a line on 2%. Okay, 2% is right here. So since 98, they've pretty much been below 2%. So what I think they're trying to do is keep it above 2% for, I don't know, like 10, 20 years. I don't know how long. But specifically the words was that they want it in one of the speeches, that they want an average inflation target of 2% over a certain term. They never, ever, ever specified over how many years. They can keep it at above 2% for 20 years if they want, maybe just 2 years. Obviously, sending it to 6.79% has a huge impact, and they might not keep it underneath 2% for as long as it was underneath 2%. But over maybe 100 years, they want an average of 2%, and they're factoring all this. I don't know, to be honest. Personally, I think it's probably more so like the last, since 2008, like the last 10, 15 years. But I don't know. That's just a hunch. I have no idea. Right, my point is that this has always been the monetary policy. Kevin Warsh has not changed anything. He's not changing. The Federal Reserve is a committee of people. And people know this. It's just the media doesn't really show it like this. It's a committee of people that vote. There's like 16, 15 members. The chairman, who is elected, he just represents the opinions of all the members. You see, when he talks, he's like, the members expressed this, the members did not express this, we disagreed on this, we all agreed, no member shared this opinion. Like, he's just up there representing the Federal Reserve. Okay? And so these like 15, 16 people, this system of people, they haven't changed what the monetary policy is. It's always been they want to be above 2%. They don't want inflation to go back to 2%. So it makes sense now that inflation is that they're going to, you know, they have it where they want it, and they're not gonna like cut the rates yet. They want inflation expectations elevated. They've always said they wanted inflation expectations elevated. They've always communicated that too, and it's exactly why they're not going to keep cutting rates. And like exactly how we saw in 2023 to 2025, right? If I go back to my presentation, in this whole cycle here, 2023, 2025, I kept telling my friends, I kept winning bets and being like, they're not going to cut, they're not going to cut. And finally, I lost a bet when they cut. And you know what? I was still technically right. They were not easing. They will not ease. They will not ease until they reach their goal. And the goal is to have an average inflation target of 2% over the next number of years while maintaining maximum employment. And next number of years could be any number of years. I don't know. While they keep maximum employment. And that's another thing too, maximum employment. What does that mean, maximum employment? Maximum employment that the economy can allow? What if that's 0%? What if no one can be employed? That's the maximum. Like, you know, there's the way they communicate things, you have to read in between the lines. And communication, the truth is their number one tool that they use to set interest rates. They themselves say this in their speeches. Not maybe not the chairman when he goes out and talks to everyone or anything, but like if you read the plans of the monetary policy that we're in right now from years ago, from like 2021, like before COVID, to like 2019, 2018, okay, like they've always said that before there was a time, I think around the 80s or 90s, where before that, the Federal Reserve never ever came out with data. They never told you what the CPI was or the interest rates unless it was important, and like, I don't know, there was a leak or somehow somebody asked and they told them. Or you were your own economist and you did your own math and you estimated the inflation. Again, like, the inflation is just what the Federal Reserve estimates. Okay, they might not be the real inflation. They might be messing with the numbers. In fact, the Federal Reserve has a mandate that allows them to lie. It was a bill that was passed. I don't know what bill it was again, but there is a bill that passed that allows the Federal Reserve to lie for national security reasons. If you ask ChatGPT, it will not tell you that. I tried, but then I found the bill and then I mentioned it to chat and then it said, oh yes, this is a real bill. So I don't know what it is called, but maybe some people have heard about it and they know what I'm talking about, and you can tell me in the comments. But it is a real bill that says the Federal Reserve can lie for national security reasons on any economic data that they have. I'm not saying that they lie. I'm just saying that before, people used to calculate it on their own. The same way the Federal Reserve calculates it, they're more sophisticated and they have more data, so they can get a better estimate now. And now that they've always been able to do that, but now that they actually report it, they started doing so because they realize that people start building expectations when they create a narrative and they report data. And then how they communicate their stance and what they see coming in that data through various speeches or the chairman press conference. How they communicate that data is also very important. I believe is more important than anything. So when it's not surprising me that I see Kevin Warsh come up here and start talking about how, there might be less meetings, because there's a few reasons. Like he said specifically that we're not sure yet, but it might change. They might meet less. It might mean that we meet less. The Federal Reserve may stop giving out as much data and meeting as much and basically giving their stance as much. I'm not sure if that's going to change, but if that is the case, there are only a few reasons why that could be that I think. Maybe it is that the Federal Reserve has lost control of their monetary tool, a monetary policy tool, which is communication. It's become pretty much risking that people are going to lose credibility in the Fed. I think people are at that point where they may start to lose credibility, because you think about it, this sideways. I mean, have we seen anything like this before? where it's just the real yields are just sideways like this, and people are so upset with how the economy is. I mean, I don't know, there's not that much data, but this is really looking like that. I don't have much data, so I can't really get a good idea, but my point is that this is kind of like, wait, where was I lost where I was. Oh yeah, what worries me is that people are going to lose credibility in the Federal Reserve, and when people lose credibility in the Federal Reserve, that's when shit becomes a shit show. That's when it's very bad. So the Federal Reserve does not want people to lose credibility in them, and they'll do anything they can to maintain credibility. And if that means meeting less, then maybe that's why. But this is just a hypothesis. It's not my base case. Well, I don't really have a base case. I'm just kind of observing, and we'll see. Maybe this is more communication from them, and nothing real will change. It's just, I don't know. There's like an ulterior motive or something I don't know about. Anyways, quite a long video. I just want to make this video again just to kind of note these things down as I learn and as I grow as not only a trader but an economist. Yeah, I realize that my ideas are fabricated from a lot of it from my own kind of thinking and studying, so I might not always get things right. And for that reason, I always want to make sure to tell you to do your own research. Don't just take my word for it. Don't just hear something I say and think that has to be the truth. I can be wrong, and I'm just doing this to lay my thoughts down, because I want to look back on this in the future and measure how my decision making, how my analysis, my interpretation of the economy was at the time, and what actually happened. Anyways, thank you very much for watching. If you enjoyed, leave a like, and have a good day.